I don't really go live on mine. I just kind of post videos, so there's not such a time crunch. But yeah, when you're a busy guy,
Yeah,
live it's tough.
I think I got a blur too. It's too much of a mess back here.
Yeah, do you have that light to put on your face?
No, I don't. I could try to make it, but I think we're live, right?
I think we are live. I'm just concerned about if we edit shorts from this, it might be a little blurry. Um,
Yeah, I can go look. Sorry, everyone. We're working out a lighting issue here. I'm gonna see if I can get more lights on here.
we're in alternate locations week after week. We gotta make do with
Yeah,
what
I
we
know.
can.
I'm in LA now. I think that might be, I don't have the light. I think that might be the best we're going to do. Unless no, I think we just gotta roll with it. I don't, I don't know any other.
We'll just
I don't
roll
know any
it.
other way. Unless I
Yep.
try something like very hacky here and just like that make a difference.
uh, Not too much. Maybe, you know what? There's actually a really bright light on behind you. Could you try turning that off or no? Is that like the whole room light?
Off? No,
Yeah.
it's all in one light.
All right, we're just gonna roll with it. So your home base is New York, but how often have you been there the past month? You've been flying around all over the place, right?
Not too much. It's been and yeah, part of this is like it's hard to get things going on time. Sometimes we get these road situations, but hopefully we'll still get some good shorts from this. I could also try to like relocate the computer maybe to a different angle so it's not quite so blaring. Um
Is there any
Here,
possibility if you
I
rotate
could
around so
try
that
this.
light is at your face?
Is this better at this new angle? It's a little bit weirder,
Yeah,
but
it's not. No, it actually is kind of a little bit better.
okay. Let me scoot up to it now. It's kind of at a weird slant. But yeah, okay. Sorry, apologize everyone for the technical difficulties. But I think that's probably better, right?
Yep, we'll just make do with what we got. It's fine. It's the information that matters, right? That we're gonna give. So
Yes. Yeah, and I think maybe because we're late, we have a few less watchers right now, but let's do it
mhm.
nonetheless.
Yeah, so I think we
Um,
were gonna start where we've actually hit on the past 2 weeks. It looks like we were a bit ahead of the curve with DNA, right?
Yeah, and I think I wanted to talk about let's get a live look. I was very proud of myself. It was it's not as up as much. But yeah, like at the top of, again, ENVX is up, DNA is up, and I wanted to talk about just like growth stocks a little. And one of the main things is we've talked about them a lot. And I think a good way to maybe understand investment strategies is I was looking at DNA, which Kathy Wood bought over 1 million shares of last week. And for those who don't know who Kathy Wood is, um, she's like probably the most prominent like tech growth investor specifically, and that's like her strategy. And a lot of people were talking about her ARK fund and like how much it was down and everything like that. And obviously when I would say, especially when she's buying like a smaller cap one like DNA, it's a big signal, at least to me, because it shows that like she's validated the tech, and she's very good at doing that type of thing, especially, and is a great team around her to do that, obviously. So when we see a good name there, that's very helpful. In terms of being like, oh, I think we're really onto something with our thesis and our strategy around that. But Kathy Wood, I think everybody was like kind of making fun of her when her stocks were down, like, oh, she's stupid now or whatever. After she had like, basically, they're only saying that because she had all of these years of great performance and everybody really loves her. But the thing about that is, it's like I think some people don't understand sometimes that certain people just have certain strategies, and like as I alluded to, she's got a whole infrastructure in place to be able to support that strategy and do growth stocks. Like Kathy Wood can't just in a bear market. I mean she could in theory, but her ARK ETF is a growth ETF. And growth stocks are just going to do bad in bear markets. That's how they do. So where everybody was kind of mocking her, I'm not sure she cares that much, because when people are going to care about growth stocks again, they're going to come back and own her ETF, and that's her bread and butter. So it's kind of expected when something like that happens. And that's a big difference between, I would say multi-strategy and one of the things that we've been able to do at Prospero, which is, last year I was mainly just making it as simple as possible in a very complicated market. And I would say about 70% of my investment profits last year were we made in the last, I would say, 3-4 months of the year, all with, kind of using the same information I was using in the newsletter, was mainly just trading direction on the QQQ. When I saw net option sentiment kind of agreeing with my macroeconomic picture, of basically what I would say in the newsletter. If I saw it validated, if I saw the direction validated, that would tell me that, oh, this has lasted for a few days. So it seems like it would add up. That I thought about this on Sunday, it looks true Tuesday, Wednesday, let me load up on this direction. And that's just an example of, here I move more to growth stocks again. And that's just, how you do multi-strategy things. And I think that that's the key there. And some people will say they love to relish in, Wall Street people or whatever being wrong. But sometimes people don't understand that, especially for someone who has an ETF, that yeah, it's like assets under management. You want more people to buy it, but she's playing the long game, and she has to play the long game. And the long game is her picking growth stocks and her selling her growth portfolio and kind of missing the market turnaround is much more tragic for her than something very logical like growth stocks not performing in a bear market. So I think that that's something that retail investors should always keep in mind, and I would say strive to be multi-strategy themselves, because the more you focus in on one strategy, the more narrow it gets. The more you might be setting yourself up for big losses, and B, the more you're just not kind of fit to be an investor that doesn't, I would say lean on other people's expertise more, because you will lose that big ticket eventually if your strategy is kind of narrow. And if anyone ever has any questions about what a narrow versus broad or multi-strategy thing looks like, but that I think is a good segue to, we've gotten a lot of questions about our signals. We do have, just in every newsletter, we have something that says, basically want to learn more about our signals, and it's got tons of resources in there, and you can kind of choose your own adventure. But I'm going to kind of walk through one of the reasons that I led into signals is I want to talk a little bit about them and how you might use them for different strategies. And we can kind of just walk through them one by one. We have the long-term signals, and the long-term signals at the top, just to go through them, are market similarity, upside breakout, downside breakout, profitability, and growth. And if you're just looking at pure long-term, you obviously want to start with that. And a very simple rule we actually say for any long investment is that we want upside breakout to be greater than downside breakout. Now, what do those metrics mean? Obviously, that's pretty broad, and that's, upside breakout especially, we back tested, and even before our live testing, that beat the S&P 500 80% of the days that we tested it, a basket of those high upside breakout stocks. And really the easiest way to think of that metric is we're looking for a lot of bull bets in the long-term options markets, a lot of analysts that like the stock, have price targets above where it's trading, analysts, recs on buy, upgrades for the stock, and then momentum factors. Everything from, the 52-week change to, something like RSI or something like MACD, which are, kind of statistical analyses on what, kind of movements perform well with the stock, something like an exponential moving average. And that's basically tracking statistical analysis of price factors that traditionally move the stock. And it's a really easy way to understand how you would get an upside breakout, because you have to have basically these positive options dynamics. You have to have analysts liking you, and you have to have the momentum factors. And it's pretty easy from that way to see how it works. Downside breakout is very similar, except we're looking more at the bets against the stock instead. And obviously bad analyst coverage and bad price momentum. Then profitability is just looking at like an EPS forecast, and we do our own ways of like forecasting that on top of the analyst recs, similar to growth and kind of the increase in the sales of that business. Market similarity is really just looking at how similar it is to the S&P 500. So you get a 100, it means the stock has performed pretty similar, and we expect it to perform similarly to the S&P 500 going forward. Before we move to short-term signals, I also think that a lot of people that use our signals like to use the short-term ones for a long-term. So a good example of how to do that would be like, you might like a stock long-term. It might have positive stock momentum, but if you see basically that it has low net option sentiment or low net social sentiment, those are the two ones we recommend most, or low net institutional flow, then you might say, well, I like this stock, but there might be a better time to buy it. Versus if you see those short-term signals really going way up, then you would definitely say, oh, now might be my best time to buy it. So we kind of go through some of those themes. And if you're talking about shorts, you can pretty much just reverse anything I said there for like longs and what you'd look for. So, for a long, you want a high upside breakout, low downside breakout, high profitability, high growth. And the number that we look for there is like above 120 or 130 for profitability plus growth, if you're going to invest with that as your primary thesis, even if you have kind of lower upside breakout, but you still want that to be greater than downside breakout. And then, yeah, you want not only good net option sentiment and net social sentiment, if you might want to like time the buying of your longs better. And you want to see positive trending in that as well. Now, in terms of looking at things for short-term investments, we have net option sentiment, which is very similar to upside breakout and downside breakout, except it is only looking at options, and we're only looking at if the bets are more in the positive or the negative direction, especially in terms of how those options are being priced. Because it's very hard there's a lot of retail investors could buy contracts or options contracts, but it really is the institutions that decide how they're priced. And if they're pricing them at higher prices, say if there's a call that's trading 10%, that would strike as like 10% above where the stock is trading, and a put where 10% is below the stock is trading, if those calls are more expensive than the puts, that essentially means that institutions are looking at a higher probability of the stock going up. And you can see all kinds of examples of that. That's obviously our most important, timely and unique signal, I would say. Net social sentiment is just like the general chatter on, a variety of different platforms, social media platforms, where we're just trying to assess, the directionality and how strong social sentiment is and how it's trending. A lot of social sentiment metrics we'll look at just today, but we don't do that. We actually there's a very simple reason that we look at wider timescales, and I'm not going to give away our secret sauce too much. But if you see things with like light chatter, right? And you look and say, like, even like 2 weeks ago, someone was saying bad things about a stock. Instead of treating them the same, I would rather the one that had more powerful bad signaling 2 weeks ago, even if it is a little old, over the one that like treating them equal, that they just have like slightly bad chatter or slightly good chatter now. Institutional flow is more looking at the mainly equity purchases. But the interesting thing about like any institutional flow metric is it goes off 13F filings, which the best case scenario, you're getting data that's 6 weeks old. So it is a little bit sometimes what institutions want you to see as opposed to what they have, which is why I lean on net options more, especially because that's more truthful in my estimation, and most importantly, timely. Net option sentiment, upside breakout, and downside breakout all refresh every 3 minutes. Whereas you're looking at something like 13Fs, that's once a quarter you're getting update on the positions. There's also these things called 13Gs that if a company, if a fund owns more than 5% of a stock, they have to report on that immediately, and that's more timely than a 13F. However, those don't report on every stock, and that's more sparse. So there is some timeliness to it, but it isn't as timely, certainly, as net option sentiment. Dark pool rating is essentially one of the things that we do is sometimes people look at the percent traded in the dark pool. What we do instead for that is we control for things like not only the percent traded in the dark pool, but the volume of shares traded, as well as the total shares outstanding and how much they're churning through that. Just because like a smaller stock can trade more heavily in the dark pool just because there's less shares traded, but that doesn't necessarily mean anything versus a higher volume and more share stock that's being traded heavily in the dark pool, or even above 50% is kind of a threshold that we find interesting for a large cap stock. And then short pressure rating is probably the hardest one to use because personally for shorts, I like it. A sweet spot for me is probably not at the top of the scale. I like maybe like 60, 70 short pressure rating if I'm going to pick a short, because I want to know there's institutions vested in it, in shorting the stock and have put money into it. However, if I see that get higher, I start to worry about a short squeeze, and I start to worry about retail piling in or other people piling in ever since the meme stock thing. And that's a real thing now. So that's a tricky one. And then, ideally you want lower short pressure for anything you want to go long, but realistically, any stock that's got big growth, big upside, there's going to be a certain number of people shorting it. So you're going to get a critical mass. Like even Tesla, I think I've never seen below 50 short pressure. And that's average. And that's just because you're going to have a lot of people speculating against it at any given time. So that's everything. And then it's kind of to look at, the short-term ones. We obviously really emphasize net option sentiment is the most important thing. Not only do I want to see that being high, but trending is super important. I would take a stock that is that was at 40 net option sentiment. It has like a steady climb, not a volatile climb. In the net option sentiment time glares, I take that above a stock that was at 40 and a steady climb to 60, above one that was at 80 and is down to 70, or even one that's like fixed at 65 and not moving. The momentum there is very important. Net social sentiment, I would say, is the next most important, but really net option sentiment is the big one. And I look at the other short ones as supporting factors. I don't want any of them to look bad along with that net option sentiment story. Similarly, like if I have a net option sentiment of 80, but a net social sentiment is 0, I probably won't touch that stock or anything below like 30 or 40 really. And then, you might look at the long-term ones, as I said. Like I love to see net option sentiment that's like very high or climbing, and then you have upside breakout that's way higher than downside breakout. I would say anything where the upside breakout is 40 points higher than the downside breakout, that's very, very good, 40 points or more. And then I want to see high profitability and growth. And yeah, it's kind of the reverse. If I see something in the short-term signals that I like, I also want to make sure it looks good in the long-term signals before I make a decision point on that. Because I think that that's just a really, really good way to mitigate your risk.
Okay, so that was a great breakdown. I hope that helps some people out. I think I might even post that as a full video on our channel because I think a lot of people were asking about it, and I think it's important for people to know if they're going to use the product. So that's good that we went through that. But now it's time to start the fun part of it, which is using those signals to pick stocks. So PayPal was shown and in your newsletter, and why is it PayPal over the rest of fintech, and what makes PayPal a breakout in your eyes?
Yeah, it was a tough call in our bonus picks, and yeah, we always kind of share extra information here for our loyal watchers. Square went in the bonus picks, and it was actually just like a really close call, but PayPal just like looked a little better, and it's the bigger name. And it's like I think when I checked this morning, it was 100 in social sentiment, and there's got to be something going on there. Like I don't know what, but like seeing those, there must be some bullish payment information coming somewhere. They must be doing a lot better than they thought. Like there's a lot of personal credit risk in the economy. So the best thing I can come up with is maybe there was going to be a lot like priced into, perhaps more of a downturn for those payment companies. Whereas like this big boost has like everybody's like saying like push off the recession. So I think that's what you might be seeing here. You might be seeing like a lot of these models forecasting things down, and then all of a sudden they're expecting a much better quarter. That's my best explanation for it. But there's always something up when I don't see like a singular stock that is appearing there. Like PayPal and Square, I think they were like 1 and 3 or 1 and 2 in like our short-term picks. And yeah, we added them to the newsletter. Obviously, the bonus picks for Square in my model portfolio. Actually, one of our kind of guest experts that we're bringing in here, Corey Arnolds, who is one of the influencers that we work with, who's been been a great case study of Prospero. Who always she always talks about how she got into Tesla at 107 when she saw it spike in the signals. So yeah, I think those are two stocks that we think could have a lot of upside, going into the next, few weeks. I think there's still that like looming credit issue that we keep talking about that, might hurt those stocks, but the way people are playing them, I've got to think that earnings is going to go well this week, or it would be a big surprise to Wall Street if it wasn't, and kind of surprise everybody because there seems to be pretty definitive movement in these options markets for those payment stocks.
Mm-hmm. So I know, I think a firm had some good news recently, and if PayPal has, a Threads moment like we've seen with Facebook, where Prospero was predicting Facebook to stock to go up for so long, and then we finally got the news. If PayPal comes out with something in the next month, that's going to be really interesting to see. Well, I guess we'll see.
Yeah, I would call that more run of the mill, because I think that kind of happens all the time where it's just like, yeah, like earnings for a company, whatever. There's not some big product launch. It would be really interesting if it's some big product launch. But the fact that it's PayPal and Square makes me think that it's just like the macro conditions for those businesses turned out to be better than everybody thought. And they're just it's like the market knows a little bit before everybody. And there's just going to be a coming out party when it's announced.
So fintech in general, do you like fintech as a sector, or would you stick with those?
I mean, fintech as a sector is really tough because like a lot of it is like if you look at like Robinhood, for example, Robinhood's just kind of like a shitty business. And I always say that. And it's just like they're not like their customers, they're screwing over. So it's just like it's hard. Like, and I'd say a lot of like obviously Prospero is very different. And we learned a lot of lessons from how those businesses were built in terms of just like, the kinds of things that like we knew we didn't want to do at all. And we knew we wanted to, stand up for retail investors for sure. But like even just some of the like the mechanisms by which they talk about things and everything like that, it's just like so grimy that even though we're authentic around that, we like avoid a lot of their similar language just because we don't even want to be associated. We try to be a little more like real and down to earth versus like over promising things. So when I talk about the lessons, that's what I'm referring to. But yeah, it's just there's so many different things. Like I like payments, I like future payments, like and obviously those are great tech companies. And just more and more of those, payments are going to be moved in that direction. But like, yeah, I don't know if you have any other names, but it really, really depends. And I don't like, that's one company like, when we're talking about something like, biotech, it's a little easier to like paint a broad brush because they're all doing like versions of the same things. Well, obviously, there's vastly different technologies, but for something like fintech, the businesses could be so different in their approach and their technology and exactly what the product is. Obviously, biotech, you have that same type of thing, but it's all the same type of business, right? In biotech, and we've talked about this, in biotech, you're trialing something. If it hits, it's going to be hugely profitable. If it doesn't, it won't. That's pretty much the one way it goes, no matter what your product is. There's not really a lot of like safe biotech, but like, you might view PayPal as like a safe fintech, and like Robinhood is like a highly risky fintech because like unless Robinhood figures out a way to like earn back their trust, they're a sinking ship. Like they have a great product, but they just don't operate in a way that people like, and they've lost a lot of standing in the community because of that. And I don't know how they fix that problem, but if they do, they're off to the races again. The trust thing, because I do think they have a good product. My problem is like I can't trust it, so it doesn't matter to me. And like I don't want to be in their app at all because I don't know if what they're showing me is their good product is just stocks they're trying to push me in or actually quality research, which is why we don't trade to avoid that, have trading in our app to avoid that conflict of interest. But yeah, PayPal, Square, solid companies and more in like I'd say Square, especially longer term. We focus more on PayPal just because it's the more well-known business. And I think some of this is just going to be like social sentiment spiking for it. Everybody will be like, ooh, payments are good. We better buy PayPal. You know, like Square has that a little bit, but I actually like Square's business better than PayPal's long term because of how they've ingrained themselves in like every business, how easy it is to integrate. I mean, I use PayPal here and there, but like for like all of our stuff, like all of our like paid products, it gets route through Stripe.
Hmm. Yeah, I try not to give much of my information here or like opinion here because I'm not an expert, but I like Square a lot, and I've just been a fan of Jack Dorsey for a long time. And we're going to spin from today's technology to yesterday's technology because we want to talk about AT&T a little bit. And a story broke out that I think they covered up that they had lead. They knew they had lead in their pipes that they were putting in, and it seems like a mess of a company, a mess of a stock. So, what's your opinion on it?
Yeah, I mean, and it's interesting because for anyone that doesn't know the history, there's all these like baby bells. And like that was like they were like that was like one of the big trust, like that was one of the big trust busting or not trust busting, that's what goes bad, but one of the big like monopoly busting things in the 90s that the US has ever done. It's certainly the most recent one. And so they split up all of these like, you know, AT&T companies into these baby bells. And it's a really interesting divergence because you look at something like Verizon, and their product is not great, but they have a much better product than AT&T. Like people's cell phone service, people say is pretty much universally better. My only good internet service I've ever had in my life was Verizon Fios. The rest of it has just been garbage, like complete garbage. And I always joke about this because like when I was in London, I was actually like, you know, at a friend's house where I live streamed, and his service was bad. I don't even know what they use, but the point is like New York City, like my like internet service all the time is bad because we use Spectrum and it's a monopoly and it's just horrible. But I think I saw something that was amazing, that AT&T's stock is like, you know, controlling for, you know, changes in currency, inflation, whatever, is trading exactly where it was trading in 1994, which is just like absolutely insane when you look at like all the way the rest of the businesses have grown and all of like that you know infrastructure and business and everything they had. It's amazing. But no, it's just like the perfect example of, you know, corporate rot and not being able to innovate and just like sitting on their pile of stuff. You know, the amount that they probably spend on like marketing and this and that, and just like not on their actual product is what gets you here, or like innovating on their product. And it's just like absolutely amazing that there's many third world countries that have like better internet and cell service than the US does. And that's just corporate rot. You know, I think the funniest example when I talk about Spectrum, and I will rail on Spectrum because it used to be Time Warner, and they basically decided they would rather like do a whole rebrand, change their name, you know, change their corporate entities, blah, blah, all that stuff, like as opposed to actually upgrading their service. That was the better option for them. And then it's just like the perfect example of what I'm talking about, where it's just like, you know, instead of doing that, you could just try and make your product better. But they're like, no, that's a lost cause. We just have to totally rebrand ourselves, but you know, every 10, 15 years when everybody starts hating us so much. And that's just hilarious to me that's like the late stage capitalism that we're in, where that is even looked at as a legitimate option, and then just like nobody wants to improve their products.
Well, now AT&T was like the most powerful company in the world at one point. So is all of this that's happening today brought by them getting split up into a bunch of pieces? Like, could you think if they were never split up, they still would have been the most powerful company in the world?
I mean, Verizon's had a lot of innovation. Who knows? That's a tough question. Maybe if they had like, I don't know. And maybe that's an interesting question for me to research next week. Like the history of like what executives went where, or how like Verizon ended up a better product than AT&T. But yeah, I mean, I don't know. It's tough because like on the one hand, you have this like monopolistic behavior that could have allowed them to just charge a lot more than they do for everything. And that's kind of the problem with monopolies. So maybe they would still be that like largest company in the world and still have all this corporate rot, where, but it was just like they would be hated so much more. And that's like ripe for disruption. Like if you look at that, there's so many stories in history where there's just like this lumbering giant and they might have been more lumbering. And then you might have someone completely come in and start like eating their lunch because they're more out of touch. Like, so instead of a Verizon that is a good option, there's just like this one lumbering, terrible giant, and something that was like more along the lines of Verizon quality would have come in. But the real problem is there's no way to come in because they monopolized all of the lines. So, I mean, I would say it's more likely than not that they would be, maybe in a similar spot, but everyone probably would hate them that much more because they probably would have like actually taken care of their product that much less. And nothing even like Verizon Fios would exist. And just like the one example that I forgot is like AT&T buying DirecTV. And it's like such a weird example of all the money they paid and then divesting it at like a fraction of that. Like that's such weird, terrible behavior. The idea that you have enough money to make this huge acquisition, but you acknowledge that you're so bad at managing it that someone else could do better. You're supposed to acquire things because you have more capital and you can do better with it and you are going to bring it to new heights. It is just like the height of ineptitude to pay all that money for something and somehow make the business so much worse so quickly. That's a perfect example of what I'm talking about.
All right, last question for this topic. So you mentioned Verizon a few times, and it sounded like you had nice things to say about the company. And they are getting hit by this story, which shouldn't really affect them at all. I mean, it's like it's basically AT&T specific, but it seems like telecom as a sector is getting hit by this. And Verizon stock is like, I think it's at its lowest point in multi-year probably. So do you have any opinion on Verizon stock in overall? I don't see why they'd necessarily like be negatively affected by this in the long run.
Yeah, I mean, I think some of it is just like a lot of people like T-Mobile. Like, I think part of it is just like
Starlink is
people,
sitting up there too.
yeah, like that too. I think it's just general. Like, yeah, I like Verizon better than AT&T. And like part of the reason I say it is like it's given me my only good internet service and consistent internet service I've ever had with like close to the speeds that they promised, which I don't know as to how it's not criminal to just talk about these speeds and just like never reach them. But that's a whole other topic. Um, but yeah, it's just marginally better. It's like I can feel like I can depend on my phone service. Whereas people that have like AT&T, I feel like in random places they're always just like, I don't get service. Like, but that should be like table stakes. But yeah, it doesn't mean they have a great business. Like I don't think that like, they shouldn't, it shouldn't exist that these other carriers like are coming in and beating them. Like they should either like good like existing entities, they should have been able to acquire them when they're smaller or underprice them. Like they're just stupid. Like that's what most people do when someone comes in with better prices. They're just like, we'll match them. The larger corporation should be able to do that. Like the smaller corporation shouldn't be the one willing to run at a loss to grow and beat them. It should be the larger corporation that's willing to take losses to crush them. And that's like the traditional model of like what works, but they're just poorly run by likely stupid people. I don't know them all, but likely overall, especially as a group, they're stupid.
Mm-hmm.
Because
All right.
this is business 101.
Yeah.
Like where it's just like you'll learn that as like an MBA, as like a first year MBA student, that it's just like when you have new entrants, like and they're trying to underprice you, you underprice them if you want to keep your business. It's just like it's basic shit. And like you only get that dumb if you just like are like stupid, checked out, like don't think you could lose your stake. There's a variety of reasons, but all of them kind of rolls up to just like not being savvy enough to compete against savvy business people.
Mm-hmm. So we're doing big pivots in our topics this week. So we're going for the most mismanaged company to maybe the best managed company in Microsoft. And it finally looks like after the seesaw of them going back and forth with Activision that they'll probably be able to close the deal eventually. So does this move the needle at all for Microsoft, or is it just like some cherry on top?
I was talking to an ex. Well, by the way, first I want to say is like probably the most best soundbite. ChatGPT's users went down for the first time this
Really?
month from last month. Yeah, it had just been on a straight growth curve. So that is something that's interesting to say in this grander Microsoft story here for a bit. Because also keep in mind they're running this thing at a massive loss. And I've talked about that before. And what most people don't know is that a big reason that OpenAI sold to Microsoft is not because they didn't have a business, but because they're loss leading on the compute. They're paying for this massive compute. And as the users grow, the cost just has become immense. So that's the thing. If it doesn't stay where it is and it doesn't stay the product it is, and there's all these generative AI companies coming in, that is an interesting story in terms of like where Microsoft could be. But I also heard a really like there's an ex like early Microsoft person that actually is considering investing in Prospero. And earlier, not early, like wasn't in the garage. But yeah, earlier for sure. And was talking about how like I think it was like I forget the exact price, but all the years that Ballmer was CEO, like the stock I think was like it never went above $40, which is like a mind blowing because like Nadal comes in and like all of a sudden it's just like a different business. And he was like kind of biding his time and everybody knew him as like a, you know, a good innovator there. But it's just a perfect example of like, of yeah, how like the same, basically what we're talking about with Verizon, the same business with like different managers could be a very different like growth story. And that is like, and that was, you know, I think a lot of people, it's obvious to commend them for it. But like the OpenAI acquisition is just like something that, you know, if you're a good company, you investigate. And it's quite possible OpenAI, you know, didn't even think they would sell and were just like willing to like gain investor capital. But, you know, if you're a good, large business, you figure out how to structure a deal that works for them. And I feel like there's tons of examples of like Microsoft kind of regaining its market share, doing a lot of smart things. You know, things like GitHub, like all of these acquisitions are just like really like everybody says Visual Basic, like a Visual Studio has gotten like way better. Like a lot of my coding friends use it when it was like a joke before. And it's just like smart investments that see the future that I think is just like it's a perfect example of what's going on here. I personally don't love Microsoft stock as much as some other people. And that all being said, that I love their management. I just like the big thing for me is like I don't think they'll beat Google as much as people are thinking in search. I think Google is just like they have better tech than them. And no matter like, you know, OpenAI is just one piece of tech that they acquired. Google has so many different things and have such a big advantage on their search algorithms. And like for search algorithms, like the training set is the most valuable thing. And yeah, ChatGPT is like moving on users fast, but they do not have like, I don't know, 30 years of history now. That's crazy to think something like that Google's that old. Just makes me feel very old. But yeah, there's that. And it's just like, yeah, I just don't, I think that like Microsoft products are like, I worry about their core products. Like I think the Docs products are really good. Like the big reason is like I like my Excel hotkeys and that keeps me in Excel. But like there's all these good like interactive tables. I don't know how much longer. Like if they lose Office and something comes along that's a better Office product, like they're crushed. They're done. Nobody buys PCs anymore because everybody likes like most people like Apple's better in terms of like what they'll buy personally. They just like slog through PCs at work. And that's an existential risk. And that's why I can never, no matter how good their management team is, like, and maybe they involve them, like they're dealing with this core office business product that is just like, it's kind of instantiated. And my coder friends, when I hear them talk about it, they're just always kind of like, they like kind of make fun of them for how they version things and how lumbering they are and how slow they are to improve. And that is like inherent in their code stack from what I've heard, that just the way that it's built, it's very hard to make changes to it. And so, yeah, like That's a big thing that I always worry about. And that's something that, like, I like to do my research in various parts. Various talented coders I know and some ex-Microsoft people have basically told me that, like, the code base inherently is like lumbering. And you can't like recode that whole thing when it's like, maybe you can, maybe they'll figure out a way to. But until I've stopped hearing that feedback, that's like an existential threat to their core business. And like Windows is fine. I like Windows okay. Like operating systems are all kind of like I can take it or leave it. Like people use that for the Office products, and that's what keeps them going. And that's just what I worry, and that's why I could never make a long. I mean, Prospero really liked it as much as it liked Meta, which it doesn't. I would probably invest in it. But like it just has never like the long-term options markets. I'm just going to pull it up. Yeah, it's a 45 upside breakout, a 37 downside breakout. The profitability plus growth looks really good. It's a 76 profitability, 61 growth. But Meta is like got much better upside breakout to downside breakout ratio. And Meta is an 82 profitability, 57 growth. So they're in the same neighborhood with much better options dynamics for Meta. And so it's just like, yeah, like what I would say is not like, I would say the institutions seem to agree with my logic, and long-term options bets on it just don't make sense, even though I've seen short-term ones behave very well for a while, where it's just like, it's got that threat to its, like the majority of its core business that I just can't wrap my head around. If there's a big threat to that, like it's going to tank no matter how good OpenAI is.
So do you think that's why they're so excited to close this Activision deal? Because they're trying to expand what their business touches?
Definitely,
Hmm.
definitely. Like they're trying to like they're trying to make themselves like not as dependent on those Office products and that. But like that's the thing, like it is such a big like revenue and profit center. Like in order to do that,
What
I
about
just love to Google
Azure, their cloud
what
service? What about Microsoft Azure?
Azure's good, and their cloud, but like most people don't think it's as good as like AWS or Google Cloud. Like it's there, it's gaining things, and they actually like they got this big army contract that basically everyone says they're like greasing the right palms. That was like the background on it. Um, but it's just like actually like that reminds me, like I had this like accelerator that I was a part of that I didn't really even like. It was like kind of like a school slash accelerator, and they forced us to use Teams, and they admitted that Teams was a sponsor, and that's just exactly the kind of like no matter how smart you are, like they are organized around some shitty products that like I don't like Teams. It's confusing. They do this weird thing where like you can't even have two logins and you have to have two separate apps for like business and personal. And like I couldn't even log into Teams the other day for a meeting because it was the old like business account. And like I couldn't figure it out. I'm a pretty savvy guy. I know how to code. And like I was frustrated by this experience of like trying to log out of this business account and log into the personal Teams account. Like it just was needlessly frustrating and stupid. And that's the kind of thing where it's just like, I think that's it right there. When you have these like lumbering code sets, or like you can't be agile, or I don't know, whatever it is, because I do say they have good management. So I can't tell you why this happens, but it does. And it's just like a perfect example of like them as a business. I don't really like, and I don't think a lot of that, I think a lot of that is, what's called like tech deck or debt or legacy code or all that stuff. That would be my estimate on what's going on.
So do you think they're definitely your least favorite, like Fang plus Microsoft out of all of them?
Yeah, what are the seven?
Well, yeah, now it's seven. I think it's Facebook, Apple, Amazon, Netflix, Google, Microsoft, Nvidia, I think.
Yeah, I'd say it's Microsoft or Netflix as my least favorite, which probably segues well into our next topic.
There you go. Yeah, so Netflix, probably the king of streaming, and Disney is not. And the writer strike seems to be affecting some of these streaming stocks. So do you think that's a lasting impact for these companies?
Well, I actually was watching like an AOC live stream a few, or like I guess a repeat of it, where she was talking about like people that wanted to be like scabs and support. It was just like they've explicitly said not to stop streaming things yet. But talk about an existential threat. If this drags on, and it might, it looks like the sides are like really digging in. Um, is is definitely like a very interesting thing for the business. And I actually almost wrote about this. I think it's one of the more, I was watching this like Fran Drescher impassioned speech about like how they were going to draw a line in the sand and blah, blah, and all this stuff. And it's actually really interesting. And it got me thinking, and I'm thinking about like writing an open letter about this, just so people can talk about it. But like Fran Drescher got paid $1.5 million an episode for like back in the day for the final season of The Nanny. Like
Pretty
her
good.
like acting like, yeah, she was like, well, you can't like, the studios can't like treat people like this. And it's just like, well, like what about actors? Like who decides that like some actors get like paid like $10 million a film and some get paid like peanuts, or like the writers or whatever? Like, are you volunteering to share? And I'm aware that there's writers that make like very little money, but that's an interesting part about this. Like the reason those executives make money, and I'm not saying they're right, the pay disparity is like, the pay disparity is way too big between the bottom and the top. But the reason that you, an actor, get paid less than like the CEO of a company is they're the ones that are making those decisions. They're the ones that are deciding who gets paid what, and dealing with the board and dealing with all these like really tough things that you have to like rise up to get to. And like a lot of that is back pay for their many years of being like grossly underpaid for like the extra work that they're doing. And like, I'm not saying any of it is right, but I'm saying it's a real pot calling the kettle black situation when you see like a millionaire actress who's made like $1.5 million an episode being like these greedy corporate, like, it's just like, whatever, like why, like, where are the actors saying they'll split more money with the writers? That could help smooth this over, and I didn't even see the writers were striking for a long time before the actors joined in, when there was like this AI likeness thing coming in. And all of a sudden it's like, we stand with the writers, but you didn't stand with them for a pretty long time before you stepped up. And it's just like, that's just
Stand
like
up
the
when it's starting
perfect,
to affect them. That's when they
yeah,
sit up.
yeah, that's the perfect example. And I talk about this all the time. And that's one of the reasons why I am trying to actually provide a long-term solution to what I think are some broad economic problems by like leveling the playing field with these like signals that are ubiquitous, that anyone can use and can kind of catch up to hedge funds. That's what I think is a great equalizer. But the thing that really gets me on any of these things and any of these complaints is just complaining about the people in charge and then leading a revolution. Even like, okay, you revolt, you're in charge, Fran Drescher, what are you doing? Like, how are you redistributing this? Because what I've seen from every revolution in history is that the same shit just happens. You have a revolution, and then you have the people at the top that are doing all the same shit all over again, and that always happens. Sometimes worse. You see in Russia, much worse than it is like in what it's developed. And like, at least Tsar Nicholas wasn't killing people. Stalin was taking all the money for himself and killing everybody. So it's just like, sometimes I get very frustrated by these people just complaining. We're just like, yeah, corporate greed, whatever. Greed is as old as time. Power breeds greed. What is your solution? What is your solution? Because like, that's the thing. At the end of the day, you need to have a solution. And otherwise you're just whining. And until you're just like, we're willing to give up like a structured amount of our salary for these writers to make this work, because you're not hurting for money. You're talking about how they no longer can afford the cost of living. You definitely can. For all of your complaints about like, you have this and like, people can't afford to live in LA and all that. It's like, okay, what are you doing to help them? You could help them just as much as the executives could. And until someone is willing to put their money where their mouth is, all of this like, all this like corporate greed talk is just like, no, I don't have much sympathy for Fran Drescher talking about corporate greed.
Yeah, it's human nature at the end of the day. Like if you replace the people, it's still people. So it's gonna happen like you said. But I think I asked you this before and you said you hadn't watched it, but Black Mirror, the first episode in the new season.
I watched all of Black Mirrors. Black Mirror is my favorite show.
Oh, did you watch the first episode of the new season?
Yeah, of course.
It's literally this situation that is playing out right now in
I bet
Hollywood.
like they're very well connected. I bet they knew that this was in that
But
executive
still, to
process.
spin it out that quick is like crazy.
Oh, it is. I mean, no, I mean, the thing is like one of the reasons I like Black Mirror is there are some amazing technologists in there. They clearly know, like, futurism is like a personal hobby of mine, which is basically like, somewhere between like science fiction and technology. It's like using more rational, like understanding of technology to project kind of the near future. And there's some amazing, as a pretty good futurist myself, you might say, I'm pretty good at being ahead of the curve on this stuff. In terms of near-term possible technology, they're amazing. And that's one of the things that, like, the show is gripping and the production values are high, but all of a sudden they introduce these ideas and we're just like, oh yeah, that could definitely happen. Not in the
Hmm.
not too distant future.
Yeah, I
And
love
and that
it.
one's like the perfect example. But I do think they probably had inside information about that one. But who cares? Like, you use your sources. Like, I'm sure a lot of the stuff is because they know these kinds of technologies are in development
Hmm.
already.
Yeah, yeah, it's crazy. It's absolutely mind blowing, and it's crazy because it's only the beginning for AI. So we're not even like it seems like it's going to change everything. I mean, it already is changing industries as we know them. Um, wow, so we're almost at the end, and we didn't even get to any macro stuff. So this is a short macro day for us, but Amazon had their Prime event last week, their Prime Day, which is 2 days, but they had the highest grossing Prime Day ever. So what does that say for the U.S. consumer and the economy in general?
I think it says that um oh sorry. I lost my I think it says that there's basically no scaring, like, basically all the stuff that we're talking about. Yeah, we keep talking about a credit crisis coming or whatever. But when it can, like, personal credit is pretty strained. But obviously the other thing we've talked about is like if there continues to be like economic growth and like growth in the stock market can really cover up economic pain in terms of being able to pay for debt. So you can keep on like reshuffling the chairs in the Titanic. But yeah, like I talked about this in my newsletter, it's absolutely amazing. Like now there's like, I'd say close to 90% bets on rate raises all the way through the beginning of next year, like through January, which is absolutely incredible. Continue considering that like people were talking about like maybe like a year ago or at the beginning of the year that like us needing to see rate cuts this year in order to like avert a horrible bear market. So it is just like completely flipped. And like the big thing there, and we talked about it in the newsletter, is it's just like, yeah, some of it is just like this AI rally led to a severe capitulation of shorts. And it didn't happen all at once. It's happening, more and more. But it's just like people are just like it is short sellers just getting their butts handed to them. And like slowly, like, what happens there is like not only do you have the buying pressure, but then you have the covering pressure on these like growth stocks that are being shorted, just changing. And that's happening all over the market. And yeah, it's like the market is about a mood, right? And everybody was worried about, even not getting rate decreases. And all of a sudden, nobody's worried. Now, all of a sudden, people are like, we don't care about these raises. We know the market's doing well. We know people are buying growth stocks. We don't know when they're going to stop buying growth stocks. So we better buy them now, as opposed to being worried about it. Even with the high rates, it's all about cost of capital, right? And so, like, if you have growth stocks that in a good market can easily like go up 25, 50, 100% in a year, all of a sudden, even that raised interest rate of like 6%, 10%, coupon that you're collecting looks a lot less attractive, as you're starting to say like, oh, I'm missing out on these great investments. Whereas when the market is struggling and you're basically saying like, oh, like, I don't even know if growth stocks will go up at all. Like the only stocks that I think are going to go up are kind of these like lumbering dividend, like profitability giants. And those aren't interesting, in terms of risk compared to my like clipping my coupon on my fixed income thing. But yeah, I think we're definitely seeing that even with rates going up. We're just like, you know what? That interest rate isn't attractive to me anymore versus this like growth stock that I think has a high chance of going up.
So with the CPI report coming in so good, I think it was 3% on the dot, and inflation coming down so quickly, why are rate expectations remaining so strong?
Why are rate expectations remaining strong? Oh, I
Like,
mean, I just think it's like, I think it's Powell's going to keep like the only reason Powell would have started cutting rates is because of severe economic problems. If there's not economic problems, if the stock market is performing well, Powell has no reason to cut rates. So I think we're just kind of seeing that like soft landing that's been talked about for a while. It's just like, why would he risk looking like an idiot, like, and like have lingering inflation when he can keep raising rates and the stock market performs well? That's a win-win for him. And I think that's basically what we're seeing. That's why we keep seeing it go up, because they're just like, with the stock market performing like this, we got no hope that he's going to start like evening out or reducing them. Like he is like his risk reward on that trade is very minimal. Like he has every incentive to raise it. Now, if inflation gets so low that he can like that he's just looking like a dick if he keeps raising rates, like you might see that. But yeah, I mean, keep in mind when you talk about 3%, that is a 3% increase from last year still. So like that's after we started seeing some significant inflation. Do we still see a 3% increase this year? So it's not like we're doing like fantastically on that as an economy. And that's what I think people like don't always fully realize, that it's like pegged to a year-over-year change. So yeah, I just like, unless we start seeing like, it's one of those weird things that these things are so like intertwined, where like if we start seeing the stock market suffer, then we might start seeing like the rate expectations go down. Like we saw like one of the great days in the bear market was when all those banks collapsed, because Powell was like, okay, we're going to start cutting rates. So it's like, or we're going to like, this is enough pain to like stem. So there is that push pull a little bit, but yeah, I just like, there's too much bullishness right now. Like, and that could change. Like there could be like, you never know that there's going to be an event that's going to like snap things, like China invading Taiwan, or like some severe, change in the war in the Ukraine, even though that's looking like it's really stabilizing. But yeah, like that's pretty much what you're going to look at.
Do you think there's any, or what would you say is the likelihood that we see deflation over the next 12, 18 months? Is there any chance at all?
Unlikely. Maybe with these aggressive rate increases, but like, yeah, I mean, the economy, like, remember when we said like 51% of this is corporate profits? For this, I just think there's too much corporate profits and all of these adjustments. I just like, I don't see that stopping. I just don't. I don't see what is going to stop that.
All right. Yeah. So that's the wrap of our topics today. I don't see any questions in the chat. We have a few people watching.
I've got a noon anyway.
Okay. All right. So
But
thanks everyone for
yeah,
watching.
I think we had everybody stay for the whole time, which is good. We're going to try and start on time. I hope we don't lose too many people with that. That would pain me, but I'm not going to let it get to me. All right.
Yep.
Thanks a lot.
See you
Back
right
in
next
New York
time.
next week.